All right. Today we quickly need to look at the group cash flows. All right. I'm sure statement of cash flows is not new to us. So, in fact, the way the material is set out, it goes straight into consolidated cash flow, and I'm sure that is with the assumption that you are not new to cash flow statements for individual company, that which you must have learned at the stage of FR. All right. So what the statement of cash flow does really, the idea is this: your statement of profit or loss and OCI has been prepared using accrual accounting, meaning that we did not give credence to transactions. Who is that person? Please help me mute to
support from government, from top NGOs.
Praise Koyejo.
Praise.
All right. Now, help us to mute. All right. Now, like I was saying, your statement of profit or loss would have been prepared using accrual accounting. And accrual accounting simply means that we don't give credence to transactions when either cash are paid or received. What we look at is, once we have made a sale, have we done our bits? Have we earned income? Then we recognize income. Are we contracted, or do we have a contractual obligation to pay for something? Then immediately we have that situation, we have accrued a cost, and then we recognize the cost. Now, because of that style of accounting, where you are not putting attention on when exactly cash is paid or cash is received, what your attention is on is when you have realized or earned an income. When you have, earned an income, and when you have accrued a cost or an expense, that is when you will recognize it. Now, that sort of hides away the cash activities that you have done as an organization. And if care is not taken, you will not have a measure or a report, so to say, to look at to say this is how we have spent money. Hence, your statement of cash flow is as important as other elements or components, rather, of the financial statement. As a matter of fact, some investors will be interested in your statement of cash flow so that they can see exactly where you are earning. What is your earning like in terms of the cash you are generating from your operating activities? They may also be interested to know, where have you been making your investments? Are you making investments in a direction where we can say that the earnings you are retaining into the business, you are using it to acquire assets that are going to help the business in the future? Or they may also want to know if in the past you have said you're not going to pay dividends, and now you said you're going to use those dividends to reinvest into the business. Are we recouping investment incomes from those things that we said we're going to invest in? So it tells a whole lot of information, valuable information. So it's as good and as important as your profit statement and your balance sheet. Very, very important. So we already know, I'm just going to revise a few things here, just so that we can pick it up from there. I'm sure you would remember there are three aspects. There's the operating activities. We have the investing activities. And lastly, we have the financing activities. So I'm just going to remind you or revise with you some of the things that you've already done. We know that operating activities is referring to what we have spent money on or how we have received money from our day-to-day activities. What is the primary activity of the business? Oh, we are a manufacturing company. Therefore, we would have incurred cost of production, which will roll into cost of sales, all right? And then we would have made sale of goods. Now, in doing that, we would have made a profit. Now, that profit you have realized from your operations, not all of that profit is cash. In accounting, we say an organization or an entity may have made, let's say for instance, ₦1 million profit. It does not necessarily mean that if you go and check the bank account, non-accountants, that's what they used to expect. Once you say, we made a profit of 1 million, what they expect is that when I go and check your bank statement, then I should see 1 million there. But that's not what it means, because we know as accountants that there are some non-cash expenses that because of prudence, we would have made some non-cash expenses deduction in our P&L, right? Also, we could have had some incomes that are not necessarily incomes that emanated from operating activities. For instance, you might have incomes that came as investment incomes, or let's say, for instance, you have invested in another company, they paid you dividend. The dividend you have received will go into your income statement. However, it is not as a result of your primary activities that you have generated such income. So the first thing we do with operating activities is that we try to make those deductions of such incomes. Then we add back those non-cash items. Now, the reason we are removing those incomes is so that we can go and put them where they ought to be. If they are supposed to be investment activity, for instance, investment income I mentioned, we'll take it to investing activity, we'll remove it from operating activities. Now, also, if we had paid dividend, we also do, okay, if I received dividend, that will most likely have gone to P&L. So that is what we'll do there. Your payment of dividend will not have touched your what is it called? You would have made that, taking that away from you. Okay, now, non-cash items such as depreciation, such as amortization, we'll try as much as we can to adjust for it. And then if we have now made tax payment, the actual tax that was paid will be deducted. All right. Now, we know all of this. Then another thing that is fundamental for you to look out for, meaning that the stuff I am going to be doing on my operating activities will come from, first of all, my statement of profit or loss and OCI. And then the other thing, the other place where it's going to come from is this. We're going to have working capital. Your working capital is that capital that is available for the running of the business on a day-to-day, meaning that we are looking at the current assets and the current liabilities. All right. So we're going to look at the movement in the current assets and movement in the current liabilities. Okay, so I'm just trying to revise with you so that you remember all of this. Okay, now when we go to investing activities, for investing activities, our attention will be at the non-current assets. All right, the non-current assets. That is where we would have spent money in acquisition of property, plant, and equipment, PPE, or we could have stored some of our existing property, plant, and equipment. This will feature under investing activity. So for instance, we may have to make a deduction under operating activities where there is a disposal, and you bring that proceed of that disposal to your investing activity. All right. Also, we could also look at things like investment. We made an investment, it could be in a financial asset, maybe like equity. We purchased equity of another company, or we bought bonds or things like that, or we invested in an associate. Those are investing activities. And I've said where you are going to find it is very easy, because you must know where to find it. You will find it on the non-current asset section. That is where you should look towards when you're trying to do your investing activities. Also, for financing activity, two places you should look at. You should look at the equities, and then you should look at the non-current liabilities. So that is where you're going to see your financing activities, meaning that what we are trying to say with financing activity is simple. The capital inflow or contribution for every business, you already know that your accounting equation is structured. The way your statement of financial position is structured is such that assets is equal to liabilities and equities. And why they structured it that way is to tell you that the assets of the company was financed by two things. Financed by two things. Either it is coming from the owners of the business, which is equities. We're talking about share capital. Did you issue shares? We are talking about share premium. When you issued shares, did you issue at a market price that is above your book value? So therefore, you would have a share premium. We're also talking about your retained earnings. Did you make payments, dividend payments from your retained earnings? So these are the things that will feature under financing activity. We could also look at liabilities. Did you take up loans, or did you try to reduce the loan, made payment for loans, made loan repayments? You understand? So those are the things that you're going to be seeing on your financing activity. So it's very important for you to know where to find what you're looking for when you want to start working. And again, how have I survived statement of cash flow all my years? Even in practice, it's very simple. I only look at, you can try it, pick up a question, look at the movement year on year of your balance sheet figures. When you do that movement of year on year of your balance sheet figures, the sum of all the movements is equal to the sum of your cash movement. That is the one secret that a lot of people don't know. I will expose you to it as we go on. We'll probably have maybe about maybe 2 to 3 questions to solve. We'll take a past question or two, solve 1 year, and we can wrap it up. And I want to believe that by the end of the class, you'll be able to solve a cash flow statement question, even if it is regards to group. All right. So this is just the revision that was needed for us to do. All right. Do we have any questions whatsoever? Anything that you have from maybe from the past, you used to have issues with it? Any question at all? before I move on.
Please, could you repeat that line again? That year-on-year movement of balance sheet items. Please,
Okay, let me show you. Okay, it is best for me to do that to make it obvious for you with individual company, but we are dealing with group. Anyway, I will show you what I mean. So what I mean is this. When you do your sorry. So this is what I do in practice anyway. I simply look at it like this. I say, all I am analyzing, all I am doing is I am trying to analyze this movement. The movement that happened here. Each of these lines. Remember that when you are doing movement in current assets, you will not touch cash. That's the only cash and cash equivalent is the only current asset that you leave behind. Then you come here, you do the same thing for all the lines. Now, when I'm doing that of assets, any increase in assets, I'll take it as a negative. Any decrease in assets is what I'll take as a plus. But for liabilities and equities, I'll take it straight. All right. Now, what I'm saying is this: all this movement, when you have done that, it is going to equal to the change that you have here. The difference here is how much? 9,030. You can try this thing later afterwards. 9,030 minus, what do we have there? Prior year. $3,640 minus 3,640.
5390.
5390. Now, if you do what I've asked you to do the opposite of this movement in terms of sign. I mean, if it's an increase, make it a minus for assets. If it is a decrease, then make it a plus. That's for assets. For the rest, do it as a form. If it's an increase, it's a plus. If it's a decrease, it's a minus. Yeah, do that. Now, when you've done that, add up all those movements, you will see that it will equal to the change between this cash, which is what your cash flow is trying to explain to you. However, you are not going to do it straight. So the scope I use, this is the sense I use in practice. When I'm dealing with things like, I know I'm going to deal with, in dealing with PPE, it can go like three direction. I could have had a disposal. I could have had an acquisition. Again, there would have been depreciation, which I'm adding back. So what I do is I look at my line, what is it called now? I look at my PPE line. I look at the movement. All of that analysis I did must be equal to that movement. Because that's what you're doing basically. You're looking at the movement. Don't worry. We'll expose ourselves more to it. It's best, especially for those who are doing my FR students, to come in handy for them more. The reason being that for you, we're going to have more information that has to do with the activity of the group that are not stated here. So that is still going to come into the picture as well. So it may not be as straightforward for this class if I'm teaching you that style. But for FR students, it is straight to the court. It's a very good way to be able to analyze where your problem is coming. So you will not present it like that to your examiner, but it will help you to be able to know where the issue is coming from. Like I said, for PPE, for instance, I have calculated the movement in my PPE and it is 1.5 million. So I now go to my cash flow. I will add what I have done on acquisition, what I have done with disposal, what I have done with depreciation. The three of them should sum up to that movement I am seeing here. If it doesn't sum up, then probably that's where my problem is coming from, if it's not balancing. So I do that a lot. And it has always been helpful, even in practice. All right. Okay. Let's get to it. Okay. So I want to believe every one of us here at one point in time or the other, we have gone through statement of cash flow. All right. So the material says, the material says knowledge of cash flow of single companies is a prerequisite for preparing consolidated cash flow. Yes, because all we are going to take into consideration are the special effects or special features of consolidated cash flow that were not an issue for you or was never an issue for you when you were dealing with individual companies. All right, let's look at it like this. The first thing first they mentioned here is cash flows that are internal to the group should be eliminated. Now, you're going to have cash flows that, let me put for instance, when you acquired the assets and liabilities of the subsidiary as a parent company, part of the assets that you acquired was cash. You will agree with me? Cash was part of the assets that you acquired. Of the subsidiary. So this must be netted out of the group cash flow. It has to be netted out, okay? Let me see if they give an example. They say where a subsidiary joins or leaves a group during a financial year, the cash flow of the group should include the cash flow of the subsidiary undertaking concerned for the same period as that for which the group statement of profit or loss and OCI includes the result of the subsidiary undertaking. That seems like a lot. Let's look at an example. It said if a subsidiary was acquired on 1st April 2017 and the date of consolidation was 31st December 2017. This means that the post-acquisition proportion of profit or loss of the subsidiary is to be consolidated for 9 months. Now, the same principle applies when consolidating the statement of cash flow of a group, meaning that the cash flow, the cash that you came in and met when you were acquiring that company will be netted out. It will be netted out. It is the cash flow that came after you had acquired the subsidiary that will be consolidated into the group cash flow. All right. Also, B, you have acquisition and disposal of subsidiaries. So the cash flow arising from acquisition and disposal of subsidiaries should be presented separately under investing activities. The amount shown for purchase or disposal of subsidiary will be the amount paid or received net of cash and cash equivalent acquired or disposed. I think this is what I have just explained. So I'll move on. Sorry. Okay. Then another thing again is non-controlling interest. The non-controlling interest. For non-controlling interest, if you are giving any dividend rather to the non-controlling interest, you will need to figure that out, how much has been paid. to the NCI. Now, usually that would have been netted off in your consolidation because the NCI is seen as part of the group. So you'd have made a deduction if there was a dividend paid. What we normally do to NCI is to say their share of the profit, meaning we have taken all of the share of the profit has been accounted for. So if dividend is paid, what you do is to make that deduction. You will see that that's the same thing we do. What I mean is this. We will normally account for NCI like this. The NCI, its valuation at acquisition, and then we say share of profit. Now, if I have already accounted for that share of profit and the subsidiary company now made a dividend payment to the NCI, what I would do is say dividend received in jackets, all right? And this will be the carrying amount. Whatever is left will be the carrying amount of the non-controlling interest. Now, if this had occurred, that is, if dividend had been paid to NCI in my cash flow, I am going to account for it. I'm going to account for it under the investing activities. I mean, under the financing activities, because NCI is a component of equity. All right. Okay. Let's look at what they did here so that we can gain better understanding. I said the following are extracts of the consolidated report for Cavico for the year ended 31st December 2016. Consolidated statement of profit or loss and other OCI. Then they gave us profit before tax, income tax expense, profit for the year. And then we have the allocation of the profit attributable to owners of parent 67.5, NCI got 22.5, right? Now, consolidated statement of financial position extract shows you the balance brought forward. In 2015, we closed with 450. 2016, it is 459. So the question you should be asking yourself, how come NCI got 22.5? If you pay attention to it, what was attributed to NCI is 22.5. That should be an addition to this 450. And that should have given me 47.5. So how come, I say 47, 472.5. That is 450 plus 22.5. Yes, it should have given me 472.5. How come at the end of 2016, what I have is 459 instead? This is my balance carried down. Now let's see what that is. It is the dividend that must have been paid that caused that, meaning that we had accrued for 22.5. Then a part of that 22.5 that we had accrued for, that makes up the carrying value that we were expecting, this 472.5. Part of that share of profit was paid as dividend. So we'll make that deduction. However, the standard will tell you the reason you are even deducting is because NCI is a part of the group. So any payments that is made when they are part of the group, what you do is to eliminate it. All right. So now you have eliminated that dividend, but because you are doing cash flow and it is a payment, it will show up in your financing activity. We'll see that when we get to a full-fledged question. Tutorial note is here for you to read so that you can gain better understanding of it. All right. Okay. Another one is investment in associates. Investment in associates. So it's the same gist we have in with associates. If we have made an investment in associates, we would have accounted for it using equity accounting, almost similar to what we just did with NCI. The day we made the investment, we'll measure, when we are, for the sake of consolidation, we'll measure investments in associates by saying the amount we invested plus the share of profit. And then any dividend that is paid will make a deduction, all right? Now, that dividend that we received, I said paid, that dividend that we received, that we canceled out, we are going to say this is an investing activity. So it should go to part of the dividend received from associates, should be part of the investing activity because it's a cash flow, all right? And that is what was done here. Let's look at this small question here. They said the following are extracts of the consolidated reports for Radoco for the year ended 31st December 2016. And consolidated statement of profit or loss and OCI. We're given the PBT, the share of profit, income tax, profit for the year. Now, your consolidated statement of financial position, investment in associates, opening figure is 176. 176. Closing is 184. The difference between 176 and 184 should be probably 8. So you're asking yourself, how come their share of profit was 20? How did they end up with 184? If we add their share of profit of 20, we get 196. So how come they have 184? Remember that you are doing equity accounting. If you end up with 184, then it must have been that dividend has been received. So the difference between this and the final balance, which is what they have done here as well, is
okay.
So meaning that out of the 20, they had received 12 as dividend. So it is the remaining 8 that you are seeing here as a movement. All right. So we must have that ability to and we have been doing it from FR. So I believe it's not going to be a problem. It's just that these are the ones that we must pay attention to. So all the same, before we go forward, the material has helped us to highlight 4 things that we must pay attention to before it goes on to say, let's solve a question. And what are those 4 things? Number 1, it says cash flows that are internal to the group should be eliminated. Number 2, it says acquisition and disposal of subsidiaries. Number 3, it says the dividend that the group would have paid to NCI that's something that you never had to deal with when you were doing FR. And number 4, it says investment in associates. I will always encourage you, even if you want to solve past questions and all that, come back to this material, read what is there. It's going to help you, and it is very, very short and straight to the point. Okay. Let's look at the question here.
Come on, close it.
Let's look at the question we have. I intend to end the class by 7, so I want us to go in straight. Now we're told Rapid Co acquired 40% interest in Jeffco on 1st January 2013. It also acquired a 75% interest in Manco. Mr. Olusoji, please help us mute. We can hear the noise in your background. All right. Now, Rapidco acquired 40% interest in Jeffco on 1st January 2013. It also acquired a 75% interest in Manco on 1st January 2015. The consolidated account, so meaning that, let me see, this is year ended 31st December 2015. Okay, so the acquisition was done at the beginning of the year. All right, let's move on. It was not done during the year. Let's move on. And then they gave us this consolidated statement of profit or loss and OCI for the year ended 31st December 2015. They gave us consolidated statement of financial position as at 31st December 2014 and 2015. They gave us additional notes. But before I go to additional notes, let me see what do they want us to do. They said we should prepare a consolidated statement of cash flows for the Rapid Group for the year ended 31st December 2015 as required by IAS 7 using the indirect method. There is no need to provide notes to the statement of cash flow. All right. Okay. So I didn't mention the other time our the methods are just limited to only one part of the activities, and that is the operating activities. The operating activities can be done using the direct method or using indirect method. Now, more often than not, what is popular is the indirect method. What is popular is the indirect method. Now, where it is practicable, the standard encourages you to go ahead and use the direct method. However, for ease, so that with the information you have, you can do a walk back, what is more popular is the indirect method. All right, let's go into it. Time is not on our side. Bearing in mind something, so that before we go and start doing the work, I want you to bear in mind certain things. There are 4 things we had mentioned. We had mentioned that these 4 things, you will come across it when you are doing consolidated financial statement. You did not come across them when you are dealing with, or you will not come across them when you are dealing with individual company statement of cash flows. All right. What are those 4 things? I'll repeat them again. We said those cash flows that have to do with internal arrangement or internal trading, all right, between the owners of the group or between the members of the group. Number 1. Number 2, we made mention of acquisition, cash payment and receipts for acquisition and disposal of subsidiary. Number 3, we made mention of dividend that must have been paid to NCI. And number 4, we said dividend that the parent company would have received as share of as dividend from associates. All right. So those are the 4 things we have to pay attention to. But we didn't read the whole of the question. Additional notes for the question says, A, there had been no acquisition or disposals of buildings during the year. When I see this, I become tempted to say, okay, let me look at what they are saying. Buildings. I come and check building. All right. If there has been no acquisition or disposal, what is the only carrying amount to reduce 50 of depreciation. All right, I should be thinking of depreciation. All right, but let's move on. What's the other additional information? We're told plant costing, I'll use Naira. That CU does not work for me. I'll use Naira. Plant costing 1 million Naira was sold for 1 million, resulting in a profit of 200,000. Okay, let me read that again. Plant costing 1 million Naira was sold for 1 million Naira, resulting in a profit of 200,000. New plant was acquired in 2015, including additions of 1.7 million acquired under finance lease. Okay, no wahala. This one was with finance lease. I think finance lease definitely is under our non-current liabilities, obligation under finance lease. So we have a new one. No problem. I'll come back to analyze these ones. Information relating to acquisition of man. Okay, so this is what I mentioned the other time, that you'll be given a breakdown of the net asset that was acquired. Now, the net asset that was acquired, normally you have plant, inventories, trade receivables, cash, trade payables, income tax, and then you have the non-controlling interest, and then we have a goodwill. All right, okay, and then to pay for this, the consideration was in shares. 1,760,000 shares were issued as part consideration, and balance of consolidation paid in cash was 28,000. So what you have there is 576. Okay, let me just quickly explain this so that you understand this information here. Sorry. This information here is a walk back to this. So you are used to, this is how you normally get your goodwill, right? You would have said purchase consideration, NCI, and then you say net assets acquired, and now that in OSC, retained earnings, pre-acquisition retained earnings, whatever other reserve they have. And then you get your goodwill, assuming there's no impairment on goodwill. All right. So now what they have done here is to walk back to get this purchase consideration. Meaning that another thing they now did, instead of giving you ordinary share capital and retained earnings pre-acquisition, they gave you line by line assets and liabilities that was acquired. They gave you line by line assets and liabilities that was acquired. And it is for a reason. It is for a reason they gave you separate like this. It is so that you will be able to do some adjustment. All right. For instance, I had made mention of cash. And I said that that cash that was acquired, you will net it off. Okay, let's move on. So at the end of the day, we know what the requirement is. We have looked upon the additional information as well. So the next thing will be for us to solve. Now, for us to solve, to do the workings, some workings I will do They are part of the workings that you are already used to. And then when we get to the ones that I'll be picking from inside this box, I'll remind you, I will tell you. So our advice, okay, maybe I should just do a screenshot like we normally do. Which do we even prefer? Do you prefer I explain from the solution, or we do a new page and solve together whilst I just do the screenshot? Because what used to bother me is for me to go back to the question. Unfortunately, I am not one to dwell too much on formats. So what I will do is I'll take us through the workings. But I'm hoping that when I get to the solution, we'll be able to move along with me. Okay, maybe we'll just go back to the solution when I'm done doing the workings. First thing first, I want to get out my depreciations. All right. The depreciation charge, I want to get it out. Okay. First one that they made life easy for me with was building. They told me there was no acquisition, there was no disposal of building. All right, now let's go into adjustment for building. First working. Sorry. All right, according to the question, go to the balance sheet. Let me pick my question here so that it's easy for me to go to the balance sheet. You see building 2014, it was 4,400. Now there are three things that will usually affect building. What are those three things? You could have had an addition. We could have had a disposal. It could have been depreciation. But then there's also one thing. It could also be an asset of the subsidiary, which we must have cancelled out against at the point of acquisition. So I'll add, before I add subsidiary, let us check. Was there part of the assets and liabilities of the subsidiary that we acquired? Do we have what is it called? Building as part of it. Do we have building as part of it? No, we don't. It's not there. All right, so no need. Now, all of these together should sum up and give me the balance carried forward. Or you can, if you like, you can say beginning of the year. You can do this. I feel like this makes it easy for you, especially if you are not used to balance brought forward, balance carried forward. All right. The balance brought forward, balance carried forward or balance at the end of the year is the final balance we have for 2015. And it was 4,150. Weston told me there is no addition. Weston told me there is no disposal. Therefore, the only thing that could have happened is that the gap between these two would have been caused by depreciation. My depreciation would have been 4,400 minus 4,150. And that will give me 250. Right? Secondly, another item of PPE. I'm picking it from my non-current assets so that I can deal with any issues there. We're told that in 2024, the balance brought forward for this asset was how much? 2,800. All right. And they told us in terms of cost. Now, the way I treated, I'm not going to treat plants like that. You know why? For plants, they gave me an analysis of the costs, and then they gave me analysis of the accumulated depreciation. So if I want to get depreciation for plants, I will be using the accumulated depreciation of plants, the movement on the accumulated depreciation. Is this clear before I move forward? Is this clear? It should be clear, but if it's not clear, please let me know. Not clear, sir. All right. Okay, somebody said, what about revaluation? Don't stress yourself. If there is going to be revaluation, if there was anything revaluation, the question would have made you know. All right, it is clear from what I see, and it is the assumption all the time we normally go with, that the company is doing PPE, they are not using revaluation method. Most companies don't use revaluation method. All right, so if it was revaluation method, they would have mentioned it. You would have even seen it somehow in your OCI. When they were giving you POL and OCI, you would have seen it there. All right, okay. Also, you said it's not clear what I've just explained. What I'm saying is this: they gave us costs, they gave us depreciation. What this means is that they account for their depreciation in accumulated depreciation, and any acquisition or additions is taken to this asset ledger. Then the subsequent depreciation will be brought here. So if I want to adjust back and get the depreciation for the year, or you can say depreciation charge, I'm going to use the accum depreciation. But if I'm looking for, the cost of the item that we disposed, I will adjust it here. If I'm looking for, they told us we acquired an asset, they give me the cost, I will bring it here. So the things I'm going to see under cost will be the additions and disposal. All right, at their cost. The things I will see on accum depreciation will be the accumulated depreciation of what we disposed and the depreciation charge. Because when you dispose an asset, what you do is you will say credit the cost, you will debit the accumulated depreciation, if there is a mismatch here, that mismatch will either be a gain or, what am I even saying? Let's do it like this: disposal of non-current assets. All right. When I credit costs, my cost will come here. When I debit accumulated depreciation comes here. Now, the implication of this is that if cost of the item cost of the item minus the accumulated depreciation is going to tell me the carrying amount of the item I am about to dispose. If what I have received, bank, debit bank, the credit leg comes here, received. Let me make it easy. Let me even use what we have here. They told us that we disposed an asset. They said the cost of the asset is 1,000. They said what we received is also 1,000. All right? What we received is 1,000. They now told us that we have a profit. A profit of how much? A profit of 200 naira. A profit of 200 naira. Now, what does a profit of 200 naira mean? A profit of 200 naira means that this 1,000 naira we receive, it is 200 naira more than the carrying amount of the asset we just sold. I don't know if you get what I'm saying. It means it is 200 naira higher than the value of the asset that we have just sold. All right? Therefore, the accumulated depreciation I'm even trying to remember they said profit was 200, cost must have been 1,000. Accum depreciation, carrying amount should be 800. Therefore, this is 200. Okay? Accum depreciation would have been 200. And therefore, I'm taking to P or L 200. This is what I was trying to do. So 200, my P or L, we have that 200. All right. Is this clear? What I have just done here, is it clear?
No, sir.
Okay. This is it. I've not used T account in a while. All right. So this is it. Let me use plus and minus to make you understand. Cost of the asset that we disposed is 1,000 naira. They said that the profit we realized is 200 naira. Profit on disposal is 200 naira. We sold it for 1,000. So bank would have received 1,000. The cost of the item we sold when we bought it originally was 1,000. Now, if the cost is 1,000, there is a likelihood that we would have calculated depreciation on it. All right? So what we'll do is we'll be asking ourselves, then what is the accumulated depreciation on this item? I now said, let's do a walk back. Let's do a walk back. How do you normally get profit on disposal? You will get profit on disposal by saying sale proceed the proceed is 1,000 minus the carrying amount. They have told you the profit on disposal was 200. So if profit on disposal was 200, then carrying amount of the assets should have been 800. Do you understand this one? Is this? Hello, is this one straightforward? What I have just done now. sale proceed is 1,000, and the profit on disposal is 200. It means that the carrying amount of the asset that we sold is 800. Now, they have given us the cost of the item that we disposed. The cost of that item is 1,000. If carrying amount is 800, then it means the accrued depreciation would have been 200. So that's how I got this 200. Is it clear now?
Yes, sir.
All right, thank you. Let's move on. It means I will not have to explain it when I'm doing it now. Okay. Did we have additions? Yeah, we had addition. The question told us that we bought plant of 1.7 million, which they said we financed with lease. All right. Now, did we make disposal? The disposal that we show here is the cost, if you remember. But one thing I said you should continually check for is the assets. The assets that you acquired from the subsidiary. So you check the assets from the subsidiary, you go to that last additional information. They gave us the breakup of the assets that was acquired. And in there, we have the subsidiaries plant. All right. So the subsidiary plant is there. So we're going to add back. At the end of it all, balance carried forward was 2,170. So what would have accounted for that break? We must have paid cash. All right. They didn't tell us how much cash we paid. All right. So let's look at it like this. 2,800 plus 17 minus 1,000 plus 300. That should be 45 minus 1,000, 35. 35 minus 330. Are we together? Oh, supposed to be plus 330. 35 plus 330. And then at the end of the day, we have 6,000. Sorry. We have 6,000 balance carried forward. 6,000 minus 3,830. You get 2,170. This is the cash paid. All right. Now, we have dealt with the costs part of the plant, and that has given us the cash paid for acquisition. Now, let's look at depreciation charge for the year. Depreciation charge for the year. Now, for this depreciation charge for the year, I'll look at my accrued depreciation. and say balance brought forward was how much? According to the question, balance brought forward, was 2.2 million. Disposal. We made a disposal. I have already calculated that disposal. The accumulated depreciation of that disposal, I said, is 200. And I said, how you will know? Sale proceed, 1,000. Profit on disposal is 200. Therefore, carrying amount is 800. If carrying amount is 800, amount is 800, cost is 1,000. It means that cum depreciation must have been 200. All right. So disposal, what I'm going to put here, what I put here was cost. What I'm going to put here is the cum depreciation, which is how much? 200. So that should have reduced our accumulated depreciation balance. However, at the end of the year, balance carried forward was how much? Balance carried forward was 2,400. Therefore,
the depreciation is 2,000. 20%.
depreciation is how much?
Yes, opening balance is 2,000.
2,000. Let me go back.
Yes, as per SFOP.
Might be one of those figures that was not written correctly. Okay. It's 2,200. It's an error from the question. How you will know? Let's go back. Look at it. Building was 4,400. Plant was 2,800. Abi? Isn't it? If I add that together, I get 7,200. Are you doing the calculation with me? Hello, class. Are you doing the calculation with me? I want to show you there's an error there. It's not 2,000. It's supposed to be 2,200. Are we together?
Yes.
All right. So 4,400 plus 2,800 is 7,200. If you minus 2,000, what you get is 5,200. Do you understand? The original text where this was called from, the amount there is 2,200. Sorry, it was a typing error. All right, let's move on fast. So, when I come here, I say, if my balance brought forward is 2,200, disposal was 200. My balance at the end of the year should have been 2,000. Okay? But I'm forgetting that there must have been depreciation charge for the year. So that will explain the difference between 2,000 and 2,400. 400 will be the depreciation charge for the year. $400. It means that my total depreciation for the year will equals 250 plus 400 equals 650. Now, this is usually the first addition we normally make to adjust for profit before tax or profit after tax or profit operating profit, whichever one you start with. It's not a problem, but you will always make an adjustment for non-cash item. And the first non-cash item that will normally come to mind is depreciation. And we've done that now. But not only that, we've also done the cash paid for the acquisition we made. All right. Another area we must treat there is the matter of income tax. All right. Now, somebody will say, what about the profit, the 200 naira profit you made on disposal? That's not a problem. I already told you that that profit that we made on disposal is going to be deducted from the profit. And the reason we are doing that is to reclass it. We are doing that to reclass it. It's an investing activity. All right. Okay. Let's move on. Next item I want to look at will be income tax. How much is the tax that was paid? The question did not tell us, but we can work it back and we will get it. All right. Income tax. Now our tax was split into two. We have the current tax and we have the deferred tax. When I go to my liabilities, under liabilities, you will see current tax under current liabilities. The deferred tax may show up under non-current liabilities. All right. So I'll say balance brought forward, current. How much? Current was 434. Deferred under non-current liabilities is 26. Now the addition that will be made here will be the provision for tax in the current year and the movement of the deferred tax. I'm still going to do IS 12 together. So the addition we will have during the year, will be income tax and movement of the deferred tax. All right. 782 and 28. Where am I going to find this movement? Where am I going to find the income tax expense? I'm going to find them on the P or L. Just go to the P or L. I'm going to find it there. All right. Now, I should go ahead and say the difference between this and the balance carried forward is but like I said, for every note that you are working on, go and check that breakup of the assets and liabilities that was acquired. And then you will see that the tax liability that was acquired from the subsidiary was 34,000. So I'll say subsidiary. Subsidiary how much? 34. Now let's add up, not to waste time. Let's add up the deferred tax and current tax that was carried forward in the consolidated account that was given to us. 924 plus 60, and that will give us 984. Okay, meaning we close the year with 984. Then the tax paid would have been a deduction. All right? Let's add it together. 434 plus 26. 434 plus 26. That should give me 460. I'm coming. This is supposed to be 782. 782 plus 208 plus 34. What do you get? 434 plus 36 plus 782 plus 208 plus 34 1494
1494.
minus 984
510.
I'm coming 534. That's not what I got in my calculation earlier. Plus 782 plus 208 plus 34 1484. Now 1484 minus 984, we get 500. All right. So this was the tax that was paid. All right. Now, I have dealt with the items that I expect to affect my operating activity. The rest of them I can do. It can be, that one is easy to do. And I will do them not forgetting that they are also represented on the breakdown of the cash and liabilities of the subsidiary. What am I referring to? I'm referring to the working capital, the changes in the working capital. Don't forget that there is trade payables under the assets we acquired from subsidiary. There is inventories there. So those things I will handle them later. For now, let me go to some of the things I said you should pay attention to. All right. The things I said you should specially pay attention to because you are dealing with consolidated. We have already seen one of them and I believe we're getting used to it. The one we have seen show up so far are those items that we acquired. Now, there is one part that is part of what we acquired that we have not dealt with, all right, which is the cash. When I am dealing with changes in working capital, I will not deal with that cash. But I can deal with it here. I can net it off here by saying, okay, in the purchase of subsidiary, in the purchase of subsidiary, the cash we acquired, their cash balance was an amount 224. But don't forget, we also paid cash. Abi? We paid cash. We paid the cash of how much? Paid to subsidiary. We paid 28,000. So this will be our net payment. For acquisition of subsidiary. This will show up as an investing activity. It will show up as an investing activity. So it is not a payment, rather it is a receipt, because what we acquired, the cash we acquired is more. So it's net cash received. Net cash received from subsidiary. All right, let's move on. Another item that we should pay attention to is the NCI. I made mention of NCI the other time. Let's look at the dividend that must have been paid to NCI. So now we are looking at special cases. Dividend paid to NCI. At acquisition, if you go and look at what they did there when they were doing the breakdown of the net assets of the subsidiary we acquired, we valued NCI to be 126,000. They valued NCI to be 126,000. Now, the share of profits that was allocated to NCI, the share of profit that was allocated to NCI was 200. If you are wondering where did we pick up the 200, that breakup was done. Let me see. The group. If you look at the group statement of profit or loss and OCI, the group made a profit of 2,690,000. The attributable profit distributed to owners of the parent was 2,490,000. The remaining 200,000 was attributable to NCI. So it is that 200,000 that I am making reference to. All right. So now when you add that together, it means that your NCI should have been 326,000. All right. It should have been 326,000. But if you look at the equities under SOFP, if you look at equities under SOFP, you see NCI showing there as 230. So therefore, balance carried forward was 230. Okay. Now that 230 shows that we have a reduced amount than what we should have had. Then what could have been the case? We must have paid dividend. Dividend paid. And that dividend paid to them would have been an amount, the difference between 326 and 230. 326 minus 230 will give you 96. All right. Okay, I made mention of 4 things. We have been dealing with number 1 in part, which is the transaction that would have taken place at acquisition. I said we could also deal with, dividend paid to NCI. I said we also deal with the dividend that the parents must have received from investment associate. Now let's deal with that. All right. I'm going to erase the first part that we dealt with earlier. So let's deal with the dividend received from associates. Now, the first thing we go for is what was the carrying amount of our investment in associate. Go to the SOFP. What's the name of the company? They probably would have, okay, they just said investment in associate. Now, in 2014, the investment was worth 2,000 naira or 2 million naira. Balance brought forward 2,000. Now, share of profit, SOP. The share of profit, let me see, did they mention? Let's go to the POL. If you go to the POL of the group, you see 700. Share of profit after tax of associates, 700. So I'll come there, I'll say 700, yeah? That should have been an addition. And that should have meant that our balance carried forward 2015 should have been 2,700. Now, the fact that it is 2,200 at the end of it all is indicating to you there must have been a deduction, and that deduction is in line with equity accounting. Dividend received will be how much? 2,700 minus 2,200 is 500. So they must have received 500 naira. All right? Okay. Is there any other thing that is a special item that may require me to do some other workings? Now, if you look to your share capital, usually share capital remains the same. If share capital increases, then it is most likely that you must have issued shares. And if you go back to the question, additional information, the last additional information told us that the consideration for the acquisition of the subsidiary included the issuance of 1.76 million shares for an amount of 550,000. So now we need to rework how they got 550,000. Okay, now that's not even the most important thing to me. I am seeing that there is a increase in share capital, but if you look very well, you will see that your share premium also increased. So if I don't want to waste my time, I will see that what it means is that we must have issued those shares at an amount that is higher than the book price. How do I get the book price? Simple. Go to the SOFP, Statement of Financial Position. You will see that the share capital is 0.25 per share, 25 kobo per share. If it is 25 kobo per share, let's come here and do it. Share premium. I can say share capital and share premium. You see, the number of shares we issued was 1,760,000. Book value is 0.25. So the increase in our share capital should be this value. If I do 1,760,000 times 0.25, I get an amount 440,000. Okay. Now, if the consideration for these shares is 550,000, then it must mean that our share premium would have been 110,000. So the cash that we got, or the cash for the share capital, ordinary share capital, is 440,000 naira, whilst the cash, or the capital issuance rather, for the share premium must have been what? 100,000. Is that simple and straightforward? Is it clear? I want to know if this one is clear before I move forward. Nobody's saying anything. Is it clear?
Yes, sir.
All right. So what we do here is to say, all right, ordinary share capital, share premium, balance brought forward. How much was the balance on the ordinary share capital in 2014? It was 4,000. For share premium, it was 4,190. And then we issued ordinary share capital element of it is 440. The share premium element is 110. All right. Now, if the balance carried forward is an amount balance carried forward for ordinary share capital was 7,880, and share premium was an amount $5,766. This difference is the cash received. All right. Now, what's the difference between 7,880 and 4,440? $3,440. Whilst for share premium, this will be 4,300 minus 5,766. It's a receipt because it's also in positive. 4,300 minus this. Let me go back to the SOFP again. What's our final balance there? For share premium, 5,766. All right. 5,766 minus 4,300. $1,466. So the difference we have there as cash received, 1,466. All right, I think we are almost home and dry. The only thing I have not touched at all will be with regards to finance lease. Okay, I think let's go back. If you look at it, we have looked at almost all the movements. The movements we have not touched at all. Let me start from the top. When I'm looking at my SOFP, I've dealt with building, I've dealt with plants. Goodwill has been dealt with as well in parts, because that goodwill, you see the breakup or the breakdown of our acquisition of subsidiary. We've dealt with investment in associates by looking at the movement, and we saw that there was a dividend that must have been received. Long-term investment has remained the same. All right. I said you are still going to deal with inventories, receivables, and we must pay attention. We must pay attention to that of the subsidiary, which they have broken down for us. We have looked at share capital. We have looked at share premium. All right. We are going to look at retained earnings. That one is easy. I can do that workings on the face of this actual statement. We have looked at NCI. All right. Loans. They didn't tell us any new thing about loans, so it's straightforward. If loans increased from 1,000 to 2,930, then it means that we must have had new loans came into the book. We'll take up that movement as additional loan capital. All right. Obligation under finance lease. There's a new one, so that will require me to do an adjustment for you there. We will do it as simple, straightforward. We've done deferred tax. We've done income tax. Okay, another thing will be the accrued interest and finance charges. All right, remember that this current liability, the movement should show on the face of the SOPL. All right, so I'm going to go to my SOPL to find out if there was interest payable there, interest expense. All right, okay. They were talking about income as well from long-term investment, and then they now netted off the interest payable. They wrote income payable. The intention is interest payable. I don't know how you're going to do it. Just make that note there. It's supposed to be interest payable, not income payable. Let's go and deal with interest first. I think I want to deal with interest first. That one is straightforward and easy to deal with, because when I'm looking at my interest movement, interest payable is 300. Interest in the previous year, if you go to your current liabilities, the balance brought forward, the finance charges and accrued interest was 60, all right? And then it grew to 80. So if I look at my income statement, I should be seeing 20 as the interest payable or finance cost. When I'm looking at it, I'm seeing expense of 300. It means there must have been some interest payments during the year. All right. So let's look at it. So what I will say is this. Interest payable brought forward was 80. Or accrued interest payable. Balance brought forward was 60. The addition or interest expense, which you can trace to the SOPL, was 300. Meaning that my balance carried forward should have been an amount 360. But when I look at my balance carried forward, what I see there is 80. 360 minus 80, it means we paid interest. Interest paid. $240. All right. 240. I would say what gave birth to this interest must have been a loan, which is a financing activity. So it goes to my financing activity. All right. I will take that interest paid of 240 to my financing activity. All right. What else? I made mention of the lease. Why are we doing the lease as well? Let's look at the lease. They told us in the additional information that there was a lease of 1,700. 1.7 million naira. That addition of the new plant was financed with lease. All right. Okay, if it was financed with lease, then the expectation should be that the lease should have grown by that much. But that's not the case. If you look at lease, is showing up in two places. It's showing as a non-current asset and it's showing as a current asset. If you match them together, you have 740 in the previous year. All right. And you would have expected, if I have 740 in the previous year, and I add 17, I have 2,440. But when I look at what I have on the face of the account, current liability is 480 in 2015. Non-current liability was 1,420. That would total 19, meaning that there is a difference between what I expect and what I'm seeing there. What could have accounted for that is simple. It means we must have paid part of our finance lease obligation. So I come here, I simply say balance brought forward, finance lease. I'm almost done, everybody. Just stay with me. I know you want to break your fast and all that. Just please, let's round up together. Balance brought forward would have been the addition of 400 and 340, which totals 740. All right. We had financed plant 17. And at the end of the day, our balance carried forward was 1,420 plus 480, leading up to 1,900. Like I said, these two will give you 2,440. If you minus that from 19, we must have paid cash. So we paid part of our obligation. What we paid must have been 450. All right. Okay, now let's go to the solution. Let's go to the solution. I'll just point you to what has been done there. The only areas where I am at difference with the question, not even with the solution, is where they said under depreciation for plant. I said it's 2.2 million, not 2 million. And I also said that year where you have income payable, it is actually interest payable. It's nothing like income payable. Those are the two text errors that you have there, as far as I know. All right. Now we started with operating profit. And the wisdom in that is that don't forget that we had earlier dealt with share of profit of associates when we did the cash dividend receipts from associates. All right. So what was done here is we started with operating profit, adjustments for non-cash item. Like I said, the profit. Now look at what I was saying the other time. I want you to pay attention to this. For plants, we said that profit on disposal of plants. Since we are discussing plants, plant is a non-current asset. This is not a profit from ordinary or primary activity of the business. So therefore, that profit would have increased the operating profit. We'll deduct it. That's what we did here. We deducted it. And then depreciation, I did this earlier. I'd earlier done this. That's how we got, sorry. Okay. Now, I told you increase in inventory is supposed to be easy. You are doing the opposite whenever it is assets. What do I mean by that? If there is increase in inventory, I will deduct. If there is decrease in prepayment, prepayment is also an asset, I am going to add. So I am always going to do the opposite when I'm dealing with assets or current assets. When I come down to current liabilities, I will take it as it is. If it's an increase, I add. If it's a decrease, I deduct. All right. Now, increase in inventory. How did we get increase in inventory should be the question. Now, if you go and check your SOFP, the inventory there, the increase should have just been between, this 3,950. It should have just been between this 3,950. Sorry. This 3,950 minus 2,000. But we are going to add that asset at acquisition that you were shown here. Sorry. That asset, that inventory at acquisition here, you see the 64. So when you come here, you see 2,000 was added to 64. Prior year, they added it together before they considered that 3,950. And that's how they got 1,886. They did the same thing for trade receivables because trade receivable of 56 was there. They did the same thing for payables. Payables of 136. Yes, 136 is here. All right. The income tax paid, we are dealt with that. The income tax paid came to 500, and that was all for net cash inflow from operating activities. We are done acquisition of plant, sale proceed from plant, 1,000. All right. Now, let me show you what I was saying the other time. Sale proceed of plant minus 2,170 plus 1,000 will give me minus 1,170. Abi? And then minus 200. That should give me 1,370. It means there must have been an addition by 1,370 on my plants. Okay. What do we have here? Okay, I've not added the depreciation. What's the depreciation? Depreciation on plant was 400. Okay, I'm coming. So that you can understand what I'm saying. I just want to show you something there. Just pay attention to what I want to show you. This is how you will know whether what you've done is good, especially where you have different elements showing up like that. So minus 200. Acquisition was minus 2,170. Proceed was 1,000. Depreciation was 400. What do we get? Minus 200. If you can help me calculate, I would appreciate. Minus 200 minus 2,170 plus 1,000 plus 400. 970.
Minus 970.
I'm coming. What's the difference I am seeing here? This one should be 5,000, then 7,750. That should be 2,750, right? $2,750. Let me go back again. Is there anything I'm here to pick? Proceed was 200. Now, depreciation on plant was how much, really? It was 400. His building that is 250, okay? Okay. There's for subsidiary there. Addition 17. It must be analyzed here. Minus 27, 170. 1,000. We have looked at depreciation. 400. Hmm. 2,370. Okay, let me use another example. Let's look at wait, though. I'm coming. Okay, I can always come back to that. I don't know what's not adding up there, but I know we can always trace it back. If I use building is obvious. I want something that has many layers that I can use. But let's move on. We'll come back to it. I'll validate it, don't worry. Dividend received. Okay, investing activities now. I've told you that anything you want to put here, just go back. If you are confused, go back to your current asset. Did you do anything here? We didn't do anything here. So the only thing that will feature here is depreciation of the building, which would have put as an add back under operating activity. Did we do anything here? Okay, we had an acquisition, we had a disposal. You will see that that's what you have there. acquisition of plant, sale proceed from plant. Okay. Under non-current assets, we have goodwill. That would have been when we purchased the subsidiary, Abi. So what is the net cash? We had a net cash received position when we did it. It was 196. And that's why it's not in jacket there. I remember very well. Yeah. Okay. We go back there again. What's the next item? Investments in associates. Okay. Did we make an investment in associates? We made it, yes, in the past. And we received dividend.
That was on their chair.
Excellent.
What did you say? We received dividend from associate, okay? Now, long-term investment. The long-term investment, if you go and check your P&L, they said we received income. It said we had an income of 310. Now, the reason we did not do, so what we would have done is to add it, deducted it. We would have deducted that interest income or income from investment or investment income, whichever way they call it. What we would have done is to deduct, the same way we deducted profit on disposal, we would have deducted it and then reclassify it to investment activities. But because they used operating profit, that's why we moved on from it. So increase in long-term investment, I'm sure that aspect too, what should have been there is not 820. Let me see. This question has a lot of typo error. All right. Next week we'll pick a past question and do it together. All right. Share capital. We dealt with this one. Dividend paid. So the dividend paid here, the group made a payment of 2490. This one we are dealing with retained earnings. The profit attributable to the parent was 2490. This. However, it means that what it should mean is that perhaps our, retained earnings should have increased by this amount. But that's not what you have there. If you go and check your retained earnings, what you have there, come to retained earnings, your retained earnings increased by 1,890. 1,890. The reason for that would have been that dividend was paid. So to get that dividend paid, we'll say the share of profits minus that increase in retained earnings. The increase in retained earnings is 1,890. That's the 1,890 you're seeing here. NCI is from our workings, payment of finance leases from our workings, cash received from loans. I said when you are dealing with financing activity, you look at the equities and then you move on to the liabilities. Now under liabilities, we have loans there. I said you will take care of that increase in the loans. And then interest paid. And that's how they did the solution. So to go back to it should not be so hard. We've done the workings together. You see now we picked up the numbers. If you have any question whatsoever regarding this, please do reach out. If there's any area of confusion when you are looking at it on your own. All right, that will be all for today. We'll pick up another question, a past question preferably. If God says we're able to meet, it's the last week of I think I still have 2 companies left that are doing their audits. It's the last week, so I may not be very available this week. But after this week, I'm envisaging us having once in a while, maybe a Thursday or a Friday meeting to close up the gap. I believe we are still going, like I have said, I'm still maintaining that we are going to round up the syllabus before the end of the night. All right, thank you guys. I'll see you next week, Sunday. I think I prefer us meeting earlier like this. All right. Any questions whatsoever?